Hello and welcome. Have you ever wondered how some investors just seem to have this knack for finding amazing companies before they get popular and picking them up for a great price? Well, today, that's exactly what we're going to break down. We're going to demystify a really powerful, time-tested strategy, and we'll do it by looking at a modern tool, the Nifty 500 Value 50 ETF. So let's just start with the biggest question on pretty much every investor's mind, right? How in the world do you find those great stocks before they get super expensive? It's the ultimate goal, isn't it? Well, the secret isn't about finding something cheap. It's about finding quality that's on sale. And that idea leads us straight into our first section. The answer to that big question, well, it's not just a tactic, it's a whole philosophy. It's about finding great companies that are on sale. And that, my friends, is the absolute core of value investing. Okay, so what does that actually mean? At its heart, value investing is really straightforward. It's a strategy where you are actively hunting for stocks that are trading for less than what they are really worth, what the experts call their intrinsic or book value. You're basically trying to figure out what a company would be worth if you sold off all its assets, totally separate from the daily market hype. Think of yourself as a bargain hunter at a high-end store. You're not looking for junk. You're looking for that designer coat that just got put on the clearance rack by mistake. You believe the market is overlooking its true value, and that's where you find your opportunity. Now, to really get what value investing is, it helps to see what it's not. And this slide does a great job of showing the two main camps in the investing world. On one side, you've got your value investors. They are all about the here and now. They're digging into today's fundamentals, looking for solid, established companies that are undervalued. On the other side, you have growth investors. They're betting on the future. They're happy to pay a higher price today for a company they think is going to be the next big thing and have massive earnings down the road. It's two totally different ways of looking at the market. So, the philosophy is pretty clear, but let's be real. Who has the time to sift through hundreds of financial statements every day? Thankfully, you don't have to. And that's where modern tools come into play. So let's talk about the ETF, which basically makes this whole strategy accessible for everybody. And that brings us right to the main event, the Mirae Asset Nifty 500 Value 50 ETF. Now, an ETF, or exchange-traded fund, is just a basket of stocks you can buy and sell with one click. Simple. And open-ended? That just means the fund can grow as more people invest. But the most important part is that this specific ETF is built to follow a specially designed index of value companies. So what's its job? Well, you can see the official objective right here. The goal isn't to have some genius manager trying to pick winners. Nope, this is a passive fund. Its only mission is to give you returns that match as closely as possible the performance of that Nifty 500 Value 50 index. It's all about capturing the results of this specific value strategy, plain and simple. Okay, but how does this index actually find those 50 value stocks in the first place? This is where it gets really cool. Let's pull back the curtain and look at the actual selection process. It all starts with a huge, diverse pool of companies, the Nifty 500 index. So we're talking about 500 of India's biggest companies. This means we're searching for bargains everywhere, across all kinds of different sectors, not just in one small corner of the market. And this is the system that does all the heavy lifting. To get from 500 companies down to just 50, every single one is put through this four-part value filter. First up, earnings to price. Is the company making a lot of money compared to what you pay for its stock? Check. Second, book value to price. Are its physical assets, its stuff, worth more than the market thinks? Check. Third, sales to price. Is it bringing in strong revenue for its size? Check. And finally, dividend yield. Does it actually share its profits with its investors? Check. It's like a strict four-point quality inspection for value. So after you run all 500 companies through that tough filter, what are you left with? Just the top 50. This is your final, focused group of companies that, based on the data, represent the best value in the entire market at that time. Okay, so now we have our portfolio of 50 stocks. What does that actually mean for you as an investor? Well, it creates this really... And the fund is serious about its mission. Check this out. At least 95% of its money will always be invested in those 50 stocks from the index. This isn't about a fund manager's gut feeling. It's a disciplined, rules-based approach. It sticks to the value strategy, period. And using an ETF structure to do all this comes with some pretty awesome benefits. First, it's usually low cost because you're not paying a team to actively pick stocks. Second, you get instant diversification across 50 companies and multiple sectors with just one trade. Third, it's transparent. You can always see exactly what companies you own. And finally, you can buy or sell it just like a regular stock during market hours. It's a really efficient way to invest. Now, we need to talk about something that is absolutely critical for this type of strategy. It's a simple concept, but it's everything here. Let's talk about the power of patience. Look at this number. The fund itself recommends you plan on holding it for 5 years or more. And there's a huge reason for that. This is not a get-rich-quick plan. It can take a long, long time for the rest of the market to wake up and realize the true value of an overlooked company. And that's really the heart of it. There will absolutely be times, maybe even years, when high-flying growth stocks are grabbing all the headlines, and this value strategy seems kind of boring, but that's part of the cycle. Value stocks often have their moment to shine in certain economic conditions, like when interest rates are going up or when the economy is growing at a steady, stable pace. That's when investors tend to rotate back to companies with solid fundamentals and reasonable prices. So patience is key because you need the discipline to stick with it until that cycle comes around. Of course, we can't talk about the good stuff without being honest about the potential downsides. To make a smart decision, you have to look at the other side of the coin. So let's take a very clear look at the risks involved here. First, there's passive investment risk. Remember, the fund has to follow the index no matter what. If the index goes down, the fund goes down with it. Then there's regular old market volatility. Stocks can be a roller coaster. And since value investing often finds deals in cyclical industries, think energy, manufacturing, banking, this portfolio can be sensitive to the ups and downs of the broader economy. You've also got tracking error risk, which is just the small chance the fund's return isn't a perfect mirror of the index. And finally, liquidity risk, which means in a really chaotic market, it might be a little harder to sell instantly. And this is the bottom line, right? Every single investment on the planet carries some kind of risk. You can't avoid it. The real power comes from understanding those risks before you put your money in, so you can decide for yourself if it's a good fit for your goals. All right, let's wrap this all up. What are the key things to remember? 1. Value investing is all about buying good companies for a fair price. 2. This ETF is a simple, low-cost way to put that strategy into practice. 3. It works by filtering the top 50 value stocks from the massive Nifty 500 universe. 4. This is for the long haul. Think 5 years plus. And finally, number 5, know the risks, especially that it's a passive fund that follows its index, for better or for worse. So I'll leave you with one final question to think about. When it comes to your own financial journey, are you investing for a quick sprint or are you running a marathon? Your answer to that question might tell you everything you need to know about whether a strategy like this is right for you. Thanks so much for tuning in.